So imagine you have $500 just sitting there,
Right.
and you want to invest it. But you don't just want, like, a generic mutual fund. You want to invest in the most consequential companies being built today.
The one's actually changing the world.
Exactly. You want a piece of SpaceX as they're, building rockets to Mars, or Anthropic and OpenAI while they're literally constructing artificial general intelligence.
Right, the real frontier stuff.
So you open your laptop, you're ready to deploy your capital, and up until incredibly recently, the entire financial system would look at your $500, look at your net worth, and just completely lock you out.
Yeah, the door would just slam shut in your face.
You'd be told, well, go buy a broad S&P 500 index fund and wait 30 years. Meanwhile, all that explosive 100x wealth generation is happening behind closed doors.
And it's only accessible to billionaires and these massive institutional funds.
Exactly. But, and this is the mission for our deep dive today, we are exploring a massive tectonic shift in how everyday people like you can invest.
Because that barrier keeping you out, it actually wasn't a technological limitation.
No, not at all.
It was a legal and structural wall that was built like nearly a century ago. And what we are examining today is the exact moment that wall is being systematically dismantled.
Which is just wild to watch happen in real time. We're looking at a brand new financial vehicle that is causing an absolute shockwave through Silicon Valley. And we're going to unpack the mind of the philosopher-investor who is architecting this whole thing.
Yeah, it's a fascinating story.
So for our stack of notes today, we're pulling from this really comprehensive aggregation by Paramendra Kumar Bhagat. It's titled Revolutionary Naval, Naval's Biggest Move Yet, USVC.
And we've got a lot of varied sources in there.
We do. We're looking at SEC filing details, historical case studies on venture capital, social media reactions, and some pretty deep philosophical essays, too.
It's a really broad spectrum of material to cover.
Yeah, but by the end of this, we're going to figure out how everyday people are suddenly gaining access to these private markets, the actual financial mechanics making it possible, and, what this shift means for the future of wealth creation.
So to kick this off, the vehicle driving this whole shift is known as USVC.
Right.
Which stands for the USVC Venture Capital Access Fund. And it was recently launched by AngelList Asset Management.
Okay, let's unpack this.
Yeah.
Because the finance and tech worlds are currently exploding over those four letters, USVC.
They really are. And to grasp why, we have to look at the historical context of startup investing. For decades, the Securities and Exchange Commission, the SEC, has enforced this rule regarding what they call accredited investors.
Right, let's define that term mechanically right up front, because it's kind of the linchpin of this entire system.
It really is.
So an accredited investor is a strict legal classification. In the U.S., it basically means you have an income exceeding $200,000 a year or a net worth of over $1 million. And that excludes your primary residence.
It's a literal binary wealth test.
Exactly. If you pass it, the government says, sure, you can invest in private high-growth startups. If you fail it, you are entirely restricted to public stock exchanges.
And, we need to understand why that wealth test exists in the first place. Because it wasn't actually created maliciously by some cabal of billionaires.
Wait, really? Because it feels pretty exclusionary.
It does feel that way now, but go back to the stock market crash of 1929.
Oh, the start of the Great Depression.
Exactly. After that crash, the federal government realized that retail investors, everyday people, were just getting wiped out by shady, unregistered securities.
So people were putting their life savings into speculative stuff and losing everything.
Right. So with the Securities Act of 1933, the government essentially stepped in and said, look, private companies are inherently risky and opaque.
So they basically decided that only wealthy people could take that risk.
Yeah, the logic was that wealthy individuals can theoretically afford to lose their entire investment without ending up destitute on the street.
So it was really this paternalistic regulation designed to protect the middle class from, snake oil salesmen.
Exactly. But the unintended consequence of that rule took decades to really materialize.
Which brings us to the modern tech boom.
Right. Fast forward to the 2010s and 2020s, the regulatory environment combined with these massive influxes of private capital from sovereign wealth funds and institutions, it completely changed the game.
How so?
Well, startup companies no longer needed to go public to raise money. They could just stay private and keep raising billions.
Okay, this is where the math of wealth inequality really comes into focus. And the sources point out this historical comparison that is just mind-blowing.
The Amazon versus Uber comparison.
Yes. Okay, let's look at Amazon. They had their initial public offering, their IPO, back in 1997.
Very early in the internet era.
Right. And at the time of its IPO, Amazon's valuation was roughly $438 million.
Which is tiny by today's standards.
Exactly. And because it went public so early in its lifespan, a regular, unaccredited retail investor could just log on, buy the stock, and personally capture all that compounding growth all the way up to Amazon's current multi-trillion-dollar valuation.
They got to ride the whole wave.
Yep.
But now contrast that with a modern giant like Uber.
Right.
Uber stayed private for a decade. By the time Uber finally had its IPO and crossed over to the public markets, its valuation was already around $80 billion.
That's a massive difference. 80 billion versus 438 million.
Because the hyper-growth phase was already over.
Wow. So the private venture capitalists, those accredited investors who got in when Uber was worth 50 million or 500 million?
They had already captured the 100x and 1,000x returns before the public ever saw a single share.
So the retail investor buying at the IPO was essentially just providing exit liquidity for the billionaire.
That's exactly what was happening. And that brings us to the structural anomaly of USVC.
Because USVC is tearing down that VIP room wall.
They really are. This new fund completely bypasses the accredited investor requirement. You do not need to prove a high income. You don't need $1 million net worth.
The minimum investment is literally just $500.
Right. And for that $500, an everyday person is gaining exposure to a portfolio that includes OpenAI, Anthropic, xAI, Vercel, Crusoe, Sierra.
And arguably the most coveted private asset on the planet right now, SpaceX.
Exactly. Which actually makes up about 20% of the entire fund.
Okay, but wait. If this is so revolutionary, why hasn't anyone done it exactly like this before? Like, giving an unaccredited investor access to SpaceX for $500 sounds incredible, but it also sounds like a logistical nightmare.
It's a huge nightmare.
Because startups famously guard their private status, right?
Mm-hmm.
If I'm Elon Musk or Sam Altman at OpenAI, the last thing I want is 50,000 random retail investors calling my investor relations department asking for quarterly updates.
No founder wants that.
I mean, they don't want them cluttering up their cap table, right?
Yeah.
The official ledger that tracks who owns what percentage of the company.
Yep. And that cap table issue is exactly why startups usually refuse unaccredited investors outright.
It's just too much friction.
Legally, if a private company takes money directly from unaccredited individuals, the SEC requires that company to produce incredibly complex audited financial disclosures.
Almost as if they were a public company anyway.
Exactly. It slows the startup down to a crawl, so they avoid it at all costs.
So how is USVC bypassing this? How are they getting the capital into the startup without triggering those massive compliance burdens for OpenAI or SpaceX? Is it a regulatory loophole?
What's fascinating here is that it's an aggregation model. When a listener puts their $500 into USVC, they aren't actually buying a direct share of SpaceX.
Okay, so what are they buying?
They are buying a share of the USVC fund itself. USVC pools all of those thousands of $500 checks together into one massive block of capital.
Got it.
Then the fund itself, which operates as a single institutional entity, invests in the startup.
So on SpaceX's cap table, they don't see 50,000 retail investors.
Nope. They just see one line item, AngelList Asset Management.
Okay, that is brilliant. It completely shields the startup from the regulatory headache while still passing the economic exposure down to the individual.
Right. But, that still leaves a massive regulatory hurdle on USVC's side of the equation.
Right, because taking money from the unaccredited public requires heavy regulation. You can't just take people's money without oversight.
Exactly. And the sources note that USVC is registered under the Investment Company Act of 1940.
Okay, walk us through the mechanics of that specific law. Because I suspect it's the key to how they're actually operating legally.
So the Investment Company Act of 1940 is the foundational legislation that governs mutual funds and exchange-traded funds, or ETFs.
Like the stuff you'd buy in a normal retirement account.
Exactly. It was designed specifically to protect everyday investors when they pool their money together.
So it's strict.
Very strict. By registering under this act, USVC is legally subjecting itself to a massive amount of friction.
What kind of friction?
Well, they're required to have a board of directors where the majority are completely independent of AngelList.
To prevent conflicts of interest.
Right. They are also required to hold assets in a highly secure third-party custody arrangement, so the fund managers can't just run off with the money.
Always a good thing.
And they have to file exhaustive, transparent public reports on their holdings and valuations.
But wait, traditional venture capital funds operate as private partnerships, precisely to avoid the 1940 Act, don't they?
Yes, they absolutely hate it. Traditional VCs want to operate in the shadows without independent boards questioning their valuations and definitely without having to publicly disclose their losses.
So why would USVC volunteer for that headache?
Because setting up a 1940 Act fund is notoriously expensive and legally exhausting. A boutique venture capital firm simply couldn't afford the legal architecture to build this for $500 minimums.
The compliance costs alone would eat the entire fund.
Exactly. The only reason this exists is because of the sheer scale of the entity launching it. AngelList already manages $25 billion in assets on their platform.
Oh, wow. So they already have the infrastructure.
They possess the software, the legal templates, the banking relationships, and the automated tax reporting systems to process tens of thousands of microtransactions seamlessly.
So they are leveraging their massive institutional weight to absorb the compliance costs that would literally bankrupt anyone else.
That's exactly it. And that brings us to the fees, which is another massive disruption.
Right. Because in finance, structure dictates behavior and fees dictate returns.
Always.
If you look at the traditional venture capital industry, the entire ecosystem runs on a standard formula known as 2 and 20.
The 2 and 20 model is basically the engine of Silicon Valley wealth.
Break that down for us.
So the venture capital firm charges their limited partners, the people actually providing the money, a 2% management fee every single year on the total committed capital.
So if it's a billion-dollar fund.
The VC firm takes $20 million a year just to keep the lights on.
And that's regardless of whether they pick winning startups or losing ones.
Yep. Even if every startup fails, they still get that 2%.
Wow. And the 20 is the performance carry, right?
Correct. The carry is the slice of the profits. If that billion-dollar fund invests in a startup that explodes in value and the fund eventually cashes out with $5 billion in profit, the venture capitalists take 20% of that profit right off the top.
So they pocket $1 billion before the limited partners even see their returns.
Exactly. That carry is what builds those mega mansions in Atherton.
But the fee structure for USVC outlined in the SEC filings is a complete rejection of that model.
It's totally different.
They charge a management fee of approximately 1%, and there is zero performance carry.
None at all.
Nothing. They don't take 20% of the upside. They don't even take 10%.
It's revolutionary.
And furthermore, the filings indicate that AngelList Asset Management is actively subsidizing part of the fund's operating expenses through at least late 2026.
Just to ensure the friction remains low for the retail investor.
So what does removing that performance carry actually do for the investor?
Removing the performance carry is a structural earthquake. It fundamentally alters the math of compound interest in favor of the everyday investor.
Because you keep more of the upside.
Exactly. When a high-growth asset hits exponential returns, slicing 20% off the top drastically degrades the long-term yield.
So by removing that, USVC is ensuring that if SpaceX colonizes Mars or OpenAI achieves artificial general intelligence, the economic surplus flows directly back to the $500 investor.
Rather than stopping in the pockets of the fund managers.
Okay, so we have the capital aggregated, the regulatory hurdles cleared, and the fees slashed. But how does USVC actually deploy this money?
That's a great question.
Because if I invest my capital today, the fund managers aren't just blindly wiring money to random founders, right?
No, they have a very specific strategy. The sources outline 3 distinct deployment strategies: emerging managers, growth rounds, and secondaries.
Let's take those one by one.
So the first pillar, emerging managers, is essentially a strategy of extreme diversification.
How does that work?
USVC acts as a limited partner, investing capital into specialized early-stage boutique funds.
Oh, so they're giving money to other investors.
Right. These are the niche investors who spend their entire lives looking for 2 guys in a garage building the next big thing.
Got it.
By allocating capital to these emerging managers, USVC casts a massive, sweeping net across the very earliest stages of innovation, capturing companies before they even have a recognized name.
Okay, makes sense. And the second pillar is growth rounds.
Yeah. Once one of those tiny companies from an emerging manager's portfolio starts showing undeniable traction.
Like their revenue spikes or something.
Exactly. Maybe their user base explodes. They will inevitably need to raise a massive Series B or Series C round to scale up.
So what does USVC do then?
USVC will step in and invest directly alongside them in those later rounds, doubling down on the statistical winners.
That's smart. But the third pillar is where AngelList's unique structural advantage really manifests, right? The secondaries market.
Yeah. This is crucial, and it requires a bit of mechanical explanation because it's how they acquire shares in companies like Anthropic or SpaceX that aren't actively raising new capital.
Right. Break down the secondary market for us. If SpaceX isn't issuing new shares, how does USVC get 20% of its portfolio into the company? You can't just call a broker and buy a ticker symbol.
A secondary transaction happens when an existing shareholder of a private company decides to sell their stake to a new buyer.
So it's not the company selling shares, it's an employee or early investor.
Consider an early software engineer who joined Stripe or OpenAI 7 years ago. They might hold millions of dollars worth of stock options on paper.
On paper, right.
But because the company is private, they can't use that paper wealth to buy a house or pay for their children's college. They are asset rich, but cash poor.
They need liquidity.
Precisely. So that engineer seeks out a private buyer for their shares. And because AngelList sits at the absolute center of the Silicon Valley network, they have visibility into thousands of these potential sellers.
So USVC acts as the buyer for those employees.
Yes. They negotiate a price for those private shares, often at a slight discount to the company's last official valuation, to account for the illiquidity, and they transfer the ownership.
This allows USVC to build positions in highly coveted, mature private companies without waiting for an official funding round.
It's a huge advantage.
That makes perfect sense. But let's pause here because we need to address the reality of venture capital. We've talked a lot about the upside of accessing SpaceX and OpenAI, but here's where it gets really interesting and also a bit scary for the everyday investor.
The risk factors.
Yeah, the SEC filings for USVC are heavily front-loaded with risk disclosures. This is not a savings account.
It's definitely not.
The filings state explicitly that the fund has a limited operating history, that private companies are notoriously difficult to value, and that investors face the very real possibility of losing their entire principal investment.
Most startups go to zero. That is just the fundamental physics of venture capital.
Right.
It is a power law game. You invest in 100 companies, expecting 90 of them to fail completely, 9 to basically return your capital, and 1 to grow 10,000% and cover all the losses.
But the risk that stands out most starkly to me is the phrase illiquid long horizon.
That's the big one.
Because an everyday investor puts $500 into an S&P 500 ETF on a brokerage app.
Yeah.
Right? 3 months later, their roof leaks, and they need cash immediately.
They tab a button, sell the ETF, and the cash is in their bank account the next morning.
Exactly. But USVC does not work that way. There is no public trading market for these shares. If you invest, your money is locked up. Isn't pitching a highly illiquid asset to unaccredited investors inherently risky?
It's a very valid concern. Pitching a highly illiquid asset class to the unaccredited public requires a radical shift in financial psychology.
Which is hard to do.
The historical justification for the accredited investor rule was precisely this issue. Regulators feared that middle-class people would lock up money they needed for daily survival.
Right. If you put your rent money into a venture fund, you'll be evicted long before the fund sees a return.
Exactly. But venture capital requires a fundamental shift in mindset from stock trading to long-term holding.
The sources highlight a quote from Ankur Nagpal, who is leading the USVC initiative. He stated, "We're building USVC to be the endowment for the American people."
That word endowment is doing a lot of heavy lifting there.
What does that mean in this context?
An endowment framework is the antidote to the day trading mindset. Think about how a massive university endowment like Yale or Harvard invests.
Okay.
They are not looking for a quick profit to hit a quarterly earnings target. They are investing on a multi-generational time horizon.
So they can afford to wait.
They allocate capital to highly illiquid private assets, knowing they won't see a return for 10, 15, or 20 years. They are planting seeds for forests they will never see fully grown.
That is the required mindset for the USVC investor then?
Yes. The illiquidity isn't a flaw in the system. It is the necessary condition that allows these massive, world-altering companies the runway to build without the chaotic pressure of public market quarterly earnings.
Wow. Okay, to truly comprehend why this specific structure was chosen and the philosophy driving this push to democratize capital, we really have to examine the architect behind it.
We have to look at Naval Ravikant.
Right, the chairman of the investment committee. A man who has spent 2 decades trying to democratize Silicon Valley. This isn't just a finance story. It is the culmination of a 20-year obsession with system design and leverage.
Naval is perhaps the most unconventional thinker to achieve billionaire status in modern Silicon Valley. To decode the architecture of USVC, you really have to decode his trajectory.
So let's trace his origin story. The biographical sources provided by Paramendra note that Naval was born in India and emigrated to the United States as a child. He grew up in New York City.
Right.
And his early life wasn't characterized by prep schools and generational wealth, right? It was shaped by a stark exposure to the friction of economic inequality.
He witnessed the brutal reality of labor class struggles firsthand, but he was simultaneously exposed to the uniquely American mechanism of upward mobility through education and technology.
That duality is so important.
It forced him to look at wealth not as a static inheritance, but as a system of inputs and outputs. And he eventually made his way to Dartmouth College, where he dual majored in computer science and economics.
That academic background seems like the perfect recipe for what he ended up doing.
It really is, because computer science trains you to see the world as a series of algorithms, systems, and networks. It teaches you how to build leverage and maximize efficiency.
Right.
And economics trains you to understand human behavior, incentive structures, and how markets allocate scarce resources.
So when you fuse those two together,
When you fuse systems engineering with human behavioral economics, you stop looking at individual businesses and start looking at the structural plumbing of entire industries.
and we saw that systemic lens in his early entrepreneurial career, but it was forged through some pretty significant friction, wasn't it?
It was. In 1999, Naval co-founded Opinions.
Opinions. That was early.
Very early. Opinions was a pioneer in user-generated content. It was a platform where consumers could review products, and it utilized an early form of a decentralized trust network.
How did that work?
The system tracked which reviewers were highly rated by other users, creating a web of trust that wasn't dictated by a central authority.
So it wasn't just a business. It was a lesson in decentralized credibility and trust.
Exactly. It was attempting to digitize credibility long before modern social media algorithms existed.
But the business success of Opinions was overshadowed by a brutal corporate governance battle.
Yeah, right. It was. After the dot-com crash, Naval and his co-founders were squeezed out of the company by their own venture capital investors in a highly complex, aggressive financial maneuvering of the cap table.
Wait, his own investors squeezed him out.
Yes. Opinions eventually merged with another company and went public at a massive valuation, but the original founders saw very little of that wealth because of how the insider VCs manipulated the share classes. Naval actually sued the venture capitalists in 2005.
That is a critical piece of context. The man architecting a fund designed to bypass traditional venture capitalists experienced the darkest, most predatory side of traditional venture capital firsthand.
He saw it from the inside.
The insiders used the opacity of private markets and complex legal structures to strip wealth away from the builders.
And that trauma fundamentally altered his trajectory. He didn't just walk away. He decided to build tools to ensure founders never got exploited by opaque cap tables again.
Which led to his next project.
He started a blog called Venture Hacks, which open-sourced the secret term sheets and negotiation tactics that VCs use to control founders.
Wow, he just published the playbook for everyone to see.
He was actively publishing the playbook of the gatekeepers, and that blog eventually evolved into AngelList in 2010.
So AngelList wasn't just a platform, it was a structural innovation in finance.
Yeah.
It was basically a structural attack on the geography and exclusivity of Silicon Valley.
It really was.
Because before 2010, if you were a brilliant founder living in, say, Ohio, or even just outside the immediate social circles of Sand Hill Road in California, your chances of raising startup capital were near zero.
Venture capital was a country club. It operated on warm introductions, social signaling, and physical proximity.
So Naval didn't just play the Silicon Valley game. He looked at the board, realized the rules were rigged, and decided to build an entirely new board with AngelList.
He applied his understanding of networks and economics to venture capital itself. AngelList digitized the matchmaking process between founders and angel investors.
Which turned startup investing into an online product.
Exactly. It standardized the legal paperwork, driving the cost of setting up an investment vehicle down to near zero. It introduced the concept of syndicates, allowing a lead investor to pool capital from hundreds of smaller backers.
He took an exclusionary, localized social network and turned it into an efficient, global software marketplace.
And AngelList laid the foundational plumbing that USVC is now utilizing.
Okay, but lots of people build platforms, but they don't all get appointed chairman of major investment committees. What exactly is Naval's track record As an investor, like how was he identifying the winners before anyone else sees them?
Well, his track record is absolutely staggering. He was an incredibly early investor in Uber, Twitter, Yammer, Postmates, Notion, and OpenDNS.
Hitting just one of those companies at the seed stage is a career-defining event.
Hitting all of them requires a deeply calibrated, repeatable framework. Naval operates as what you call a first principles investor.
Meaning what exactly?
It means he ignores market momentum. He doesn't care what sector is trending on tech blogs. He doesn't rely on institutional processes. He strips a business idea down to its fundamental physics.
Okay, what does a first principles analysis look like in practice? Let's take a company like Notion, the productivity software that is now valued in the tens of billions. How does a first principles framework evaluate that early on?
Well, a traditional investor looks at Notion and asks, is the project management software market big enough? Can they beat Microsoft?
Right, standard market analysis.
But a first principles investor looks at Notion and asks, does this product exhibit exponential leverage? Naval realized that Notion was building a set of modular software blocks that users could combine to build their own infinite variations of tools.
So it wasn't just a single tool.
Right. The leverage was immense. A tiny team of a few dozen engineers in San Francisco was writing code once and deploying it instantly to millions of users globally at near zero marginal cost.
That is the definition of code leverage.
Exactly. He focuses on founders with unusual clarity, exponential markets, and technologies that enable that leverage, like software, networks, and automation.
Okay, spotting Uber and Twitter early is genius, but those were different eras of the internet. I follow the logic for software. But does his framework still apply to the current wave of hardware and AI giants?
You mean like SpaceX and Crusoe?
Yeah, exactly. USVC's portfolio is increasingly dominated by heavy frontier technology. The era of the lean software startup built in dorm room is kind of over. Does his framework of leverage and zero marginal cost still apply when the companies are dealing in atoms, not just bits?
It applies even more profoundly, just on a different axis. Look at SpaceX through Naval's framework of leverage.
Okay.
Before SpaceX, space travel was a linear, bespoke process. NASA built a rocket, launched it, and it burned up in the atmosphere. The marginal cost of the second launch was basically identical to the first.
Right, you had to build a whole new rocket every time.
SpaceX introduced the ultimate physical leverage, reusability. By landing the booster and flying it again, they broke the linear cost curve.
Oh, wow.
The marginal cost of accessing orbit drops exponentially with every flight. That physical leverage unlocks entirely new industries in space.
That makes total sense. And what about artificial intelligence, like Anthropic?
AI is the ultimate realization of cognitive leverage. If you train a model like Anthropic's Claude, the upfront capital cost is astronomical.
Billions of dollars in data center.
But once trained, the model possesses a form of reasoning. The marginal cost of having that model write one line of code or 10 million lines of code is practically zero.
It's infinite labor leverage scaled through software.
Naval's genius is recognizing the underlying mathematics of leverage, regardless of whether the domain is a social network, a reusable rocket, or a neural network.
And his association with USVC provides instant credibility because he isn't just a theorist. He has a proven history of identifying world-changing businesses early. But to truly grasp how Naval views capital and these investments, we really have to step out of the boardroom and into the mind of Naval as a thinker.
We have to explore his philosophy on wealth.
Because Naval isn't just known in finance circles. He has a massive cultural footprint as a thinker. The sources point out his wider cultural influence, largely popularized by the Naval Almanac.
Yeah, that book gathered a lot of his podcast appearances and essays.
And the sources indicate that his philosophy hinges on a crucial, often misunderstood distinction between wealth and status.
This distinction is really the engine of his entire worldview. Naval argues that society constantly conflates the two, leading to widespread misery.
Okay, let's break that down. What is status, according to Naval?
Status is your relative rank in the social hierarchy. It is a zero-sum game. If you want to be the CEO, the current CEO must be removed. If you want to be seen as the most successful person in your neighborhood, you must buy a bigger house than your neighbor.
Status is the title on your LinkedIn profile, the brand of watch you wear, the exclusivity of the clubs you belong to.
Exactly. Status games are inherently competitive, fueled by comparison, and they require constant defense. And because it relies entirely on the perception of others, it's fragile.
So if that's status, what is wealth?
Wealth, conversely, is entirely independent of social perception. Naval defines wealth purely as having assets that earn while you sleep.
Assets that earn while you sleep.
A piece of code executing transactions automatically is wealth. A factory producing goods while you are on vacation is wealth. A portfolio of compounding equities is wealth.
So wealth is positive sum. You can create a new piece of software that generates millions of dollars in value without taking a single dollar away from anyone else.
That's the beauty of it. The ultimate purpose of wealth, in his view, is not to buy status symbols to impress people you don't even like.
What is the purpose then?
The purpose of wealth is freedom. It is the absolute sovereignty over your own time and attention.
I love that. And the mechanism to transition from playing status games to building wealth is, once again, leverage.
Right, we're back to leverage.
The sources categorize leverage into 3 distinct eras or forms. Walk us through those.
The first and oldest is labor leverage. This is simply having humans work for you.
Right, like imagine you need to move a massive boulder across a field. Labor leverage is hiring 50 people to push it. It gets the job done, but managing human labor is incredibly complex.
Humans require salaries, they form politics, they get tired, they demand benefits. It is a high-friction form of leverage.
Okay, so what's the second form?
The second form, which really developed during the Industrial Revolution, is capital leverage. Money working for you.
So instead of hiring 50 people, you take your capital and buy a bulldozer. The bulldozer doesn't complain, it doesn't need sleep, and it multiplies the force of one operator exponentially.
Capital is a much cleaner, more scalable form of leverage than labor.
But historically, both labor and capital required permission, right?
They did. You needed permission from society to lead people, and you needed permission from a bank or a venture capitalist to acquire capital.
Which brings us to the third form.
Right. The internet introduced the third, permissionless form of leverage: code and media.
Products with zero marginal cost of replication. Like inventing a self-replicating wind sail that pushes you forward while you're taking a nap.
Exactly. If you write a brilliant algorithm, or record a podcast, or design a digital product, you do the work once. But that code or media can be duplicated and consumed by 1 billion people simultaneously without requiring any additional effort from you.
It works for you while you sleep.
And you don't need anyone's permission to write code. You don't need a bank loan to record a video. It is the great equalizer of the modern era.
Okay, so what does this all mean for USVC? Look at how this philosophy directly maps onto the architecture of the fund. The vast majority of the population relies entirely on the lowest form of leverage, their own labor.
They trade an hour of their time for an hour of wages. They have no assets earning while they sleep.
Isn't USVC essentially Naval trying to hand out capital leverage to the $500 investor who previously only had access to labor leverage?
I completely agree with that assessment. Naval's philosophy isn't just talk. USVC is the literal structural manifestation of handing capital leverage to the masses.
By removing the accredited investor requirement, they're allowing the everyday worker to trade a small fraction of their labor output for ownership in the highest leverage assets in human history.
The code of OpenAI and the physical infrastructure of SpaceX. It is the financial manifestation of his philosophical mandate.
But Naval's philosophy goes far beyond just making money. His massive popularity stems from what he believes you should do after you achieve that freedom.
Right, which is why the sources refer to him as a digital sage or Silicon Valley philosopher.
He takes these hard economic realities and connects them to inner psychological stillness. He argues that acquiring wealth through leverage requires a specific mindset, one free from the noise of our obsessive culture.
He frequently blends Western capitalism with Eastern philosophical traditions like non-duality and Buddhism, but he strips away the mystical jargon. He makes it digestible for engineers.
Right. He approaches the human mind like an engineer debugging a faulty operating system.
He argues that happiness is not a destination you reach after you achieve your goals. Happiness is our default state. It is the baseline that remains when you remove the friction of constant internal conflict and desire.
One of his most arresting quotes in the sources is, "Desire is a contract that you make with yourself to be unhappy until you get what you want."
It forces a massive reevaluation of ambition because modern hustle culture tells you to want everything. The promotion, the car, the startup valuation.
And Naval argues that every time you desire something external, you are introducing a bug into your mental operating system that guarantees anxiety until the desire is fulfilled. It's a beautiful philosophy, but his solution isn't just to stop working, right? He advocates for seeking accountability to build trust and finding a career that feels like play to you but looks like work to others.
Yes. He advocates fiercely for the cultivation of what he calls specific knowledge. This means identifying the unique intersections of your genetics, your upbringing, and your genuine curiosities.
Identifying what you actually love to do.
If you are doing what feels like play, you will naturally outlast, outlearn, and outcompete anyone who is just doing it for the money. You don't need discipline if you are deeply obsessed.
And he notes his definition of retirement. Not an age, but a state of freedom. You are retired when you stop sacrificing today for an imagined tomorrow.
You are retired when you do what you do for its own sake.
It is a profound, elegant framework. But let's play devil's advocate for a second.
Okay.
Because I have to challenge the reality of applying this. Is it easy to say desire is the root of suffering and seek stillness only after you've made millions on Uber and Twitter?
That is the most rigorous and necessary critique of his worldview.
Can the everyday person listening right now, say a single mother working 2 shifts as a nurse and struggling with grocery inflation, actually apply this retirement as a state of freedom mindset? Is this philosophy inherently elitist?
It can sound like a luxury belief, available only to those whose survival needs are already met. However, if you examine the mechanics of his argument, he's not presenting play and specific knowledge as the reward for success.
Oh, he's not.
No, he is presenting them as the required path out of wage labor.
How so?
Think about it. If you are trapped in an exhausting labor cycle, trying to compete in a generic field where you have no specific knowledge is a losing game, you will eventually be replaced by someone cheaper or by automation.
Right.
Naval's argument is that the only asymmetric escape velocity available to the individual is to identify their bizarre, hyper-niche curiosity, digitize it using the permissionless leverage of code or media, and scale it globally on the internet.
It's difficult, yes. But he argues the alternative, grinding away at a status game in a corporate hierarchy, is guaranteed exhaustion.
Exactly. The inner stillness he advocates for isn't a hobby for the rich. It is the prerequisite clarity needed to spot leverage points in a chaotic market.
That clarity is precisely what we see reflected in the public reaction to USVC's launch. Because people understand, this is more than just a new mutual fund. It's a structural shift in access.
The social media curation provided by Paramendra captures the immediate shockwaves of this collision of Naval's philosophy and the launch.
What are people saying?
Well, you see established tech figures immediately validating the model. Ryan Hoover, the founder of Product Hunt, publicly announced, "I just invested." Anthony Pompliano weighed in with just a fire emoji.
Which says a lot.
And Zara captured the populist sentiment, tweeting, "Bullish capital for the people." You also had Matt Brezina praising the multi-decade partnership between Ankur Nagpal and Naval that made this happen.
But the quote that anchors the entire narrative for me comes from Sakiba Najam and the sources.
What did she say?
She wrote, "Lowering the barrier to participate changes who gets to learn, not just who gets to invest. This is bigger than capital, it's access."
Changes who gets to learn. That observation cuts to the absolute core of why financial gatekeeping is so damaging. We often focus on the monetary returns people miss out on, but we ignore the educational deficit it creates.
Exactly. When you invest $500 into USVC, you are just buying future returns. You are buying skin in the game. And skin in the game is the ultimate driver of human attention.
If a teacher or construction worker suddenly owns a fractional share of Anthropic, their relationship to the news changes. When a headline about large language models or AI regulation pops up, they don't scroll past it, they read it.
They start tracking SpaceX launch manifests. They are forced to learn the mechanics of the frontier because their capital is tied to the outcome.
It converts a passive consumer of the future into an active, educated participant. The financial exposure is almost secondary to the technological literacy it forces upon the investor base.
It's like Naval operates as a reflective capitalist here, building frameworks that empower individuals rather than institutions, replacing rigid corporate hierarchies.
He really does.
And understanding the world right now means preparing for what Naval, and the blog post's author, Paramendra Kumar Bhagat, describe as the impending age of abundance.
Right. Naval has very optimistic but grounded views on the future. He sees AI as a massive leap in productivity, crypto as new financial infrastructure, and technology as a force that should expand human freedom.
They frame the rapid advancement of artificial intelligence and frontier technology, not as a dystopian threat, but as a massive deflationary force that will drive the cost of intelligence, energy, and goods towards zero.
Because if AI can write perfect legal contracts, diagnose diseases, and engineer supply chains at near zero marginal cost, the overall wealth of humanity expands dramatically.
The friction of survival drops. But let me ask you this. If USVC succeeds and forces the rest of the venture capital world to open their doors to retail investors, does this actually fix the wealth inequality Naval talks about, or just change the arena where the game is played?
Well, if we connect this to the bigger picture, the critical question is, who owns the machines that generate that abundance? If the private venture capital ecosystem remained closed behind the accredited investor wall, the entire economic surplus of the AI revolution would be captured by a few thousand institutional insiders.
The wealth gap would become unbridgeable.
Right. So while it doesn't solve all inequality, startups will still fail, funds can still lose money, it removes a massive structural barrier. It fundamentally shifts the venture ecosystem from a closed social signaling network to an open marketplace.
Which makes USVC an emergency intervention into the structure of capitalism. It's forcing a bridge to be built, just as the AI wave breaks. It shatters the velvet rope.
It democratizes the opportunity to own the leverage.
We have covered immense ground today. We decoded the historical walls of the accredited investor rule and the friction of the 1940 Investment Company Act.
We looked under the hood of AngelList's massive infrastructure, seeing how they use secondary markets and zero-carry fee structures to fundamentally alter the math of venture capital for the $500 investor.
And we traced Naval Ravikant's journey from witnessing the brutal cap table manipulations of early Silicon Valley to building the very systems that make transparent, decentralized investing possible.
We mapped his economic theories onto his philosophical framework, too. The realization that status is a zero-sum trap, that true wealth is the pursuit of assets that earn while you sleep.
And that the ultimate goal of leverage is the total sovereignty of your time.
Exactly.
So as we wrap up this deep dive, the real takeaway isn't just about whether you invest $500. It is an audit of your own operating system. Look at where you spend your energy.
Are you exhausted because you are playing a zero-sum status game?
Grinding for a title that relies on someone else's permission? Or are you focused on your specific knowledge? Are you using the permissionless leverage of code and media to build something that compounds while you sleep?
Are you designing a life that feels like play, or are you just signing daily contracts with desire, guaranteeing your own anxiety?
The shift from laboring for status to building leverage is the defining transition of a modern life. And that leaves us with one final provocative thought to consider as the future accelerates.
What's that?
We are staring down the barrel of an age of abundance. Artificial intelligence is driving the marginal cost of cognitive labor to zero. Robotics and reusable rockets are altering physical infrastructure. If these technologies fulfill their promise, and if financial vehicles like USVC succeed in distributing the ownership of those technologies to the everyday person,
The fundamental struggle for basic economic survival might actually be solved. It is the ultimate endpoint of technological leverage.
if the machines generate the abundance and you own a piece of the machines, your time is entirely your own. So what happens to human ambition when survival is guaranteed and wealth is democratized? If you no longer have to work for leverage, what will you choose to build simply because it feels like play?
That is the real question.
Thank you for joining us on this deep dive. Keep questioning the systems around you, keep learning, and keep building.